Hello, today is March 16th, 2023, and it's time for some new stock picks. As always, I'll be doing a review of the performance of my picks from this time last year, giving you a little bit of analysis on the current financial and economic environment and conditions, and giving you three new recommendations with stocks that should do well over the next 12 months and beyond. This time last year, the war between Russia and Ukraine had just broken out, and it was a volatile environment, and my thinking at the time was energy security more than clean energy would have been at top of mind for various governments and nations. And as a result, I picked a uranium stock, Energy Fuels, thinking nuclear would be again on top of mind for a lot of people. And that hasn't materialized, so that pick was down 40.4%. I also picked a cheaper alternative for housing, Legacy Housing Corporation, that provide kind of manufactured homes. Thinking in a rising rate environment, if regular homes are more expensive, they would benefit. Also didn't do too well. It was down 24%. I also picked Reliance Steel, but that was actually up very nicely, 30.7%. So the average for the three stocks over the last 12 months in US dollars, including dividends, was down 4.9%, and which compares with minus 9.4% for the MSCI World Equity Index, as represented by the URTH ETF, again in US dollars, including dividends. This highlights something that we always talk about, the need for diversification for stocks. Stocks are risky, so there's a wide disparity in performance between the three picks from last year. So from minus 40 to plus 30, 31. So staying well diversified is always a good idea. Now, market environment this year is substantially different than an economic environment than last year. We've had rates now go up on a very rapid basis since last year, the fastest rate increase in decades, from practically zero to around 5% on the short end, a little bit less in Canada, 4.5%. And that's causing problems in a number of areas, and the more levered areas of the market and the economy are affected first, and those are the banks. Banks lend, borrow on the short end of the curve. They borrow short term in terms of deposits. Deposits are kind of loans that the bank owes to the depositors, and then they either lend the money out to corporations or individuals for longer terms, like mortgages, 5, 10, 30 in the US, or if they don't have suitable loans to make, they buy things like US Treasuries, and some of them didn't anticipate this rapid rise in rates, and they bought longer-term treasuries and they were holding such long-term treasuries, and when rates went up, they became insolvent. I'm specifically talking about Silicon Valley Bank in the US that failed last week and was taken over by FDIC. This is hopefully not completely endemic of what's happening with banks, and hopefully specific to that one, that didn't manage the interest rate risks. But it highlights, and the duration risk, but it highlights the attention that now investors are given to other alternatives other than keeping the money in deposits in the bank. And one of them is obviously the first one being holding US Treasuries or government securities directly. Other one being holding gold. So with that in mind, our top stock pick is going to be a gold stock. In case what is probably a a singular incident with Silicon Valley Bank. In case that becomes more commonplace over the next few months, we'll see other banks be in the same situation, and people then are going to flock to gold, and obviously gold stocks are going to do well under that scenario. But if that doesn't happen, having a small portion of one's portfolio in gold and gold stocks is not a bad idea anyway. So the stock is Alamos Gold, symbol AGL on the Toronto Stock Exchange. It's around a 5.7 billion Canadian market cap company. Not small, not huge. And the company has been doing well, and hopefully it will continue to do well with a stable gold price. And if gold goes up, it will do even better. Again, small portion of the portfolio in gold stocks. Next stock pick is still a kind of a cyclical company, but more stable than a gold company, I would think. AGCO, a global manufacturer of agricultural equipment. So its competitors would be companies like Deere. The inflation has hit food prices a lot over the last couple of years, and is making the need for possibly higher production, higher yield, even more apparent. And for that, you need better equipment, newer equipment. And even if we go into a recession or a slowdown in economic activity, I don't think the agricultural equipment market is going to slow down as much as it would normally do. So it should be a good area to invest in. This particular company is nicely profitable, and the stock is very reasonably priced, trading at about 9 times earnings. Meanwhile, for example, Deere is trading closer to 14 times earnings, which is still reasonable, but this is better. Cheaper is better. So this should be good. And the final stock pick is a little bit riskier company. It's an operator of airports, owner-operator of airports in Mexico, Colombia, and Puerto Rico. Travel is coming back after COVID big time. And even though people may not be spending on other things if there is a slowdown, they still want to travel. They missed out on vacations for 3 years. And Mexico is a popular destination, probably Puerto Rico as well. Not sure about Colombia. But the revenue is very nicely up. They're nicely profitable. The stock is cheap. It is travel related, so if we ever go into any pandemic lockdowns again, it's going to be a disaster. But hopefully that's not going to happen anytime soon. And having, again, a very small portion of one's portfolio in something that's travel related and reasonably priced, and with that decent growth that you can see over the next 2-3 years, is not a bad idea. As always, if you have any questions about whether these picks fit into your well-diversified portfolio, or if you have any other questions about investments, please give us a call. Thank you. Have a great day.